Before banks were insured by the government, a bank failure could mean that all of your money deposited in the bank was lost. That risk proved catastrophic for millions of Americans during the Great Depression and through much of the 19th century, leading to the founding of the Federal Deposit Insurance Corporation in 1933. However, the history of insuring banks actually started earlier, with state governments leading the way. Welcome back to Economic History Files. I'm Alexander Paris-Callahan. Today, we're talking about state deposit insurance programs. Before the FDIC insured all banks in the United States, some states tried to create their own insurance programs to secure banks. The first came in 1829, when New York State launched a statewide insurance program. This program was apparently inspired by merchants in Sichuan, China. A businessman named Josh Foreman came up with the plan after hearing about how Chinese merchants protected their businesses from financial ruin. All the banks in New York had to pay into a central insurance fund. If one of them ran into trouble, the fund would step in to cover their losses. On top of that, a board of commissioners was created to audit banks and make sure they weren't running wild with any bad loans or shady practices. New York's system seemed to work, and between 1831 and 1858, 5 more states set up similar programs. These early programs had no dollar limit on how much depositors were insured for. If a bank failed, the insurance would try to cover everything, not just a set amount per person. Also, these early insurance programs didn't just help depositors. They also protected banks in other ways. For example, if a bank issued paper banknotes, which at the time were essentially IOUs for gold and silver, and then couldn't afford to redeem them, couldn't exchange the notes for gold and silver, some of these insurance programs would step in to redeem the notes for the banks. This helped maintain trust in the banking system. Since banking runs on trust, these insurance programs not only could stop bank runs once they'd started, they could also help make sure that bank runs didn't start to begin with. During the free banking era, which started in the 1830s, state governments changed the rules on how banks could issue their notes. Suddenly, many banks didn't qualify for state-run insurance programs. This was the beginning of the end. By 1866, just a few years after the national banking era had started, when banks could be chartered by the federal government, every single state insurance program had shut down. 60 years later, when the Great Depression hit, American bank depositors would have no place to turn when their savings disappeared. The creation of the FDIC solved that problem, but only after many households and businesses had been completely wiped out. Thank you for watching this episode of Economic History Files. Please like and subscribe for more on the history of money. And comment below, where would you keep your money if depositing it in a bank were highly risky?